owner of a stock will receive anything in a given year, or even anything at all. Stocks are much riskier. The return can be higher, the return could also be lower or negative. Stock tends to be most often used as a way for younger and smaller companies to raise money, more than for established companies. So the typical overall pattern is that very small firms need to find money from specialized funds like venture capital investors, or sometimes what are called angel investors, rich people who want to put their money into small companies. Or small companies need to fund their own growth in one way or another. But as firms get bigger and start having sales and profits, at some point they need a big infusion of capital. And at that point they sell a lot of stock. And that helps them really expand and get up to a large scale. Once the firm is fully established, then it tends to get its financial capital with profits, and in some cases by issuing bonds. And it will only issue more stock if, say, it's buying another firm, and it uses the stock in its own firm to buy stock in the other firm. Most firms can't quite keep just issuing stock and issuing stock and issuing stock, because stock, remember, is ownership of the firm. If you've got 100 shares in your company and you issue 100 more shares, then that original 100 owners now only own half as much of the company as they did before. Their ownership is diluted, as we say. And people don't want a company where they're getting their ownership diluted and diluted over time. Now, in the next lecture, what we're going to do is talk about stocks and bonds and bank accounts from the supply point of view. That is, not the view of the firm receiving the money, but the view of the investor who's putting money into those different kinds of accounts. But before we leave this topic of how firms get financial capital, it's worth saying that the ability of firms to raise capital and the ability of firms to invest is extraordinarily important, because investment and the ability of firms to buy new plant and equipment is one of the main contributors to economic growth over time. It's one of the main contributors to expanding productivity and expanding the standard of living. We'll talk much more about this in the macroeconomics lectures of this course, but suffice it here to say that the U.S. has tended to lag behind much of the industrialized world in the proportion of its economy that is devoted to saving and devoted to investment on the part of firms. And in the long run, if firms aren't investing in new capital and equipment, this can be highly detrimental to a country's long-run growth in its standard of living.